In today's fast-paced world, money and wealth seem to drive everything. But do we really understand the true nature of money and how to build wealth? Today on The Empowered Wallet, we delve into the shocking truths about money and wealth that you need to know. Get ready to uncover some eye-opening facts that will change the way you think about finances forever, from gold to paper. Throughout history, the concept and nature of money have evolved significantly. Once, money was backed by tangible assets like gold, meaning that each dollar represented a claim to a specific amount of gold. This system provided a stable foundation for currency, ensuring its value remained relatively constant. However, the modern monetary system operates differently. Today, money is not backed by any physical commodity, but rather relies on a system of debt and trust in the issuing authority, typically a central bank. This shift from the gold standard to fiat currency has implications for the value and stability of money. One of the primary consequences of transitioning away from the gold standard is the erosion of purchasing power due to inflation. Inflation refers to the general increase in prices of goods and services over time, resulting in a decrease in the real value of money. Central banks often aim to maintain a moderate level of inflation, typically around 2% annually. While inflation is considered a normal aspect of economic growth, it can negatively impact savers and investors by reducing the value of their savings and investments over time. Throughout history, money has evolved based on economic and social conditions. Before modern currency, societies used bartering for goods and services exchange, leading to inefficiencies. As societies evolved, the need for more efficient exchange led to the emergence of commodity money like shells and precious metals like gold and silver. Gold, in particular, emerged as a favored form of money due to its inherent properties. Gold is durable, portable, and divisible, making it well-suited for use as currency. Additionally, gold has intrinsic value and is universally recognized as a store of wealth. These qualities made gold the preferred medium of exchange for much of human history and formed the basis of the gold standard. Under the gold standard, the value of a country's currency was directly linked to a specific quantity of gold reserves held by the central bank. This fixed exchange rate system provided stability and confidence in the currency, as it was backed by a tangible asset with intrinsic value. However, the gold standard also had limitations, particularly regarding the flexibility of monetary policy and the ability to respond to economic fluctuations. The abandonment of the gold standard marked a significant shift in monetary policy and paved the way for the modern financial system. In the early 20th century, various factors, including the costs of maintaining gold reserves and the need for greater monetary flexibility during times of economic crisis, led countries to transition to fiat currency systems. Fiat currency is not backed by any physical commodity, but derives its value from the trust and confidence of the public and the government's ability to manage the money supply effectively. Dealing with inflation. While fiat currency systems offer greater flexibility and control over monetary policy, they also introduce risks and challenges. One of the primary concerns associated with fiat currency is the potential for inflationary pressures. Unlike the gold standard, where the supply of money was limited by the availability of gold reserves, fiat currency allows central banks to increase the money supply through mechanisms such as quantitative easing and fractional reserve banking. While these measures can stimulate economic growth and address liquidity issues, they also carry the risk of inflation if not managed carefully. Inflation can decrease the purchasing power of money, reducing the value of savings and investments. This presents a challenge for savers and investors, as traditional savings accounts and cash holdings may not provide adequate protection against inflation. As a result, many individuals opt for alternative investment strategies, stock market basics. One popular investment strategy for combating inflation is investing in the stock market. Stocks represent ownership stakes in publicly traded companies and offer the potential for capital appreciation and dividend income. Historically, stocks have outperformed other asset classes over the long term, providing investors with a hedge against inflation and a means of growing their wealth. However, investing in individual stocks carries inherent risks, including company-specific factors, market volatility, and economic uncertainties. To mitigate these risks, many investors choose to diversify their portfolios by investing in a broad range of stocks through mutual funds or exchange-traded funds, ETFs. These diversified investment vehicles offer exposure to various sectors and industries, reducing the impact of individual stock performance on the overall portfolio. Real assets for protection. Another investment strategy for combating inflation is investing in real assets such as real estate and commodities. Real assets have intrinsic value and tend to appreciate over time, providing a hedge against inflation and preserving purchasing power. Real estate investments, in particular, offer the potential for rental income and capital appreciation, making them attractive options for long-term investors seeking inflation protection. Commodities such as gold, silver, and oil also serve as inflation hedges, as their prices tend to rise in periods of economic uncertainty and inflationary pressures. Gold, in particular, is often regarded as a safe haven asset and store of value during times of market volatility and currency devaluation. Alternative investments. In addition to traditional investment vehicles, investors may also consider alternative assets such as cryptocurrencies and collectibles as inflation hedges. Cryptocurrencies like Bitcoin and Ethereum have gained popularity as digital stores of value and mediums of exchange, offering investors a decentralized alternative to traditional fiat currencies. While cryptocurrencies carry risks, including price volatility and regulatory uncertainties, they have emerged as viable options for investors seeking diversification and inflation protection. Collectibles, such as art, wine, and rare coins, also serve as alternative investments with inflation hedging properties. Collectibles have unique intrinsic value and tend to appreciate over time, making them attractive options for investors seeking non-traditional inflation hedges. In conclusion, combating inflation requires a proactive approach to investing and wealth preservation. By diversifying their portfolios and allocating assets across various investment vehicles, investors can mitigate the impact of inflation and preserve the value of their savings and investments over time. Whether through traditional stocks and bonds or alternative assets like real estate and cryptocurrencies, investors have a range of options for hedging against inflation and achieving their long-term financial goals. Thanks for tuning in to The Empowered Wallet. Don't forget to like, subscribe, and hit the notification bell to stay updated on our latest episodes. See you soon.